Hello, welcome to Fundamental versus Quantitative Investing. So we're going to be talking about two different philosophies, but they share the same goal, and that's outperform the market. Value investors and quantitative investors approach the market differently. Understanding both helps you build a modern investment strategy. So the story begins at the University of Chicago um, with a student named Eugene Fama, and he basically wrote something called The Efficient Capital Markets, a review of theory and empirical work. And it brought about a famous theorem that's used widely in academic finance. It's called the efficient market hypothesis. So, a market in which prices always fully reflect available information is called efficient. So, that's the major idea. Now, there could be three forms of it. There's a weak form in which the information set is just historical prices. Then there's a semi-strong form in which the concern is whether prices efficiently adjust to other information that is obviously publicly available. Earnings announcements, annual earnings, stock splits, etc. Finally, there's something called a strong form, and this is concerned with whether given investors or groups have monopolistic access to any information relevant for price formation are reviewed. I mean, this could be kind of equated to today's insider trading. So we're seeing a weak form um, of the emerging market the efficient market hypothesis. Okay, so it's just basically a random uh, price price behavior, right? Fluctuations. There's no pattern that could be detected and whatnot because all the information is being priced in. So what do value and quantitative investors agree on? Markets are not perfectly efficient. So both would argue that the efficient market hypothesis does not hold, that we could make solid predictions based on two different methodologies that we're going to be discussing shortly. Both exploit mispricings using different tools and methodologies, and both aim to maximize risk-adjusted returns. So what are the two different approaches? Let's give solid definitions behind what these exactly mean. Value investing is a strategy of buying stocks that appear undervalued based on fundamental financial metrics. Some of you might be familiar with this, like price earnings multiple, price book. There's several accounting ratios that have been developed over the years. Those would be something like where value investors would use. It's a buy and hold approach. Quantitative investing is the use of mathematical models and algorithms to make investment decisions based on data analysis. So we're going to first start talking about fundamental investing. And it starts with a book called The Intelligent Investor by Benjamin Graham. He's widely considered the father of value investing. He lays out four principles, basically, that actually five principles that are useful. We're going to look into four of them, though. First one is a stock is not just a ticker symbol or an electronic blip. It's an ownership interest in an actual business with underlying value that does not depend on its share price, right? So underlying value that's completely independent of how the stock price actually behaves. And then the market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. And the intelligent investor is a realist who sells to optimists and buy from pessimists. The future value of every investment is a function of its present price. So we get the idea of DCF, discounted cash flow models, from this basic idea. The higher price you pay, the lower your return will be. So obviously the incentive is to buy as low as possible, right? And hopefully it'll rise in the future. So no matter how careful you are, the one risk no investor can eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, you can minimize your odds of error. Okay. So, sometimes like these high flying tech stocks, startup, these new issuances, they might be something that a value investor might avoid, right? Where, people are paying way too much based on hype more than reality. So one of the major proponents of value investing is Warren Buffett, and he's got some very pithy sayings. One of them being, "Be fearful when others are greedy, and greedy when others are fearful." And this basically sums up Graham's philosophy, which, by the way, Warren Buffett was a student of at Columbia University. And another pithy saying that he says is, "I'd rather be approximately right than precisely wrong." And this kind of captures his approach to investing. Okay, so he's not going to be using mathematical precision and whatnot to try to have his stocks go up in value or his investments go up in value. And one of his great, I guess, kind of contributions to the investment world is his letters to his shareholders. This is from 1965 to 2003. We're missing a couple of years, like a year or two, but we'll be discussing what the major philosophy behind his annual shareholder meetings are. So here's Buffett's checklist for buying a stock. First, an understandable business, like meaning basically does he have some kind of competence in understanding it? He denotes it as a circle of competence, right? Knowing what you know and knowing what you don't know is more important. A durable competitive advantage, also called a moat. Capable and honest management. Predictable growing earnings. And attractive price, which is a margin of safety, right? Just that low price where if you make a mistake, you're not going to be paying for it. Now, Coca-Cola was his major investment, and it's probably one of the highlights of his career. And behind the Coca-Cola investment, there was a in his shareholder meetings, he would talk about why he made the investment and whatnot. And one of it is buy a wonderful company at a fair price. I mean, I know that I'm reiterating that fact, but yeah. So it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, right? That was in his 1989 Berkshire Hathaway shareholder letter. And in 1988, Buffett began buying Coca-Cola shares after the 1987 crash. KO, the ticker, was trading below its intrinsic value, despite its exceptional business fundamentals. This shows Buffett's preference for quality over deep discount. So here's something of a graph that kind of mimics what I just said. Basically, there's an intrinsic value, which is like the real value of the stock, but for some reason the stock market is discounting it. And eventually after, I mean, in this example, 5 years, it converges to the actual intrinsic value. So it's originally priced at like 30 or $40 or whatnot, and it'll converge to the 100, which is the actual value. And this is what Buffett was really good at. Okay, so being able to detect value in the stock despite its price. So another principle that was implemented is looking for durable competitive advantages, and Coca-Cola fulfilled that. The Coca-Cola company is the most ubiquitous brand in the world, a company whose product enjoys inordinate customer loyalty and per capita consumption. Buffett saw Coca-Cola brand, global distribution, and product consistency as a strong economic moat, a central tenet of value investing. So another principle is focus on cash flow and capital efficiency. So in an interview with Fortune 2001, he was saying, we prefer businesses that drown in cash. It's like oxygen. They don't have to constantly reinvest. So Coca-Cola requires relatively low reinvestment to maintain its position while generating high free cash flow. That's ideal for a value investor focused on shareholder returns and capital efficiency. Another principle is buy and hold. Let compounding work. This was another requirement that Coca-Cola fulfilled. Our favorite holding period is forever. That was a 1988 shareholder letter. And then we expect to hold these securities for a long time. In fact, we own portions of outstanding businesses. Our favorite holding period is forever. Buffett still holds Coca-Cola shares he bought in the late 80s. The dividends alone now return more annually than the entire original investment, a powerful testament to long-term compounding. And then finally, circle of competence. I never invest in anything I don't understand. Coca-Cola is a very easy business to understand. They make a product, sell it more than it costs, and people come back for more. Buffett avoids complex or opaque businesses. Coca-Cola fits squarely within his circle of competence, simple, predictable, and understandable. So now we're going to be talking about quantitative investing. The major guy behind, the archetype of what quantitative investing is Jim Simmons. There have been others, an individual by the name of Ed Thorpe, who's a famous mathematics professor. I mean, Jim Simmons is a mathematics professor as well, but he seems to be more representative now. And he's the owner of hedge fund Renaissance Technologies. So there's a book about him, The Man Who Solved the Market, how Jim Simmons launched the quant revolution. He's not very explicit in terms of his methodology, but there are certain passages in the book where we could kind of get a glimpse into what his strategies are. So the first thing in chapter 10 is building a trading system. So by combining all their trading signals and portfolio requirements into a single monolithic model, Renaissance could easily test and add new signals, instantly knowing if the gains from a potential new strategy were likely to top its costs. And it was also adaptive and capable of learning. And adjusting on its own, much like Harry Laufer's trading systems for futures. Okay, so he was into systems development early on. So looking for signals, the team collected every trade order, including those that hadn't been completed, along with annual and quarterly earnings reports, records of stock trades by corporate executives, government reports, and economic predictions and papers. So they were basically collecting a lot of different data, some esoteric, and that was helpful. So looking for signals, some of the new information, such as quarterly corporate earnings reports, didn't provide much of an advantage, but data on the earnings predictions of stock analysts and their changing views of companies sometimes helped. Watching for patterns in how stocks traded following earnings announcements and tracking corporate cash flows, research and development, spending, share issuance, and other factors also proved to be useful activities. The team improved its predictive algorithms by developing a rather simple measure of how many times a company were mentioned in a news feed, no matter if the mentions were positive, negative, or even pure rumor. So you see your first use of sentiment analysis in the stock market, which is pretty interesting. Staffers became excited about developing super short-term signals to trade in a matter of seconds or even less. So here's a CFA Institute review. The strategies they built weren't based on economics or theory. They were driven by empirical signal detection, with each individual signal offering only a small edge, yet combined across thousands of signals to provide a powerful predictive system. So you see a little bit of the similarities to machine learning. I mean, the idea of many weak learners, where individually that weak learner won't be able to do a good job of predicting, but if you combine hundreds or thousands of them, you get an advantage. So there's a couple of trading strategies that were mentioned in the book as well that we could kind of tease out. They scrutinize the patterns in market prices, studying how one day's price move might influence the next. And there's something called the autocorrelation coefficient that's used in time series analysis and econometrics. And that basically sees like how one day is correlated to the next day, or maybe you could even see 5 days out, right? So there's that usage of that type of statistical technique. And then second, they found, for example, that prices which moved sharply in one direction tended to bounce back. And this is mean reversion, okay? So there's basically some anomaly that deviates from its long-term equilibrium level, and then basically it would move back to that equilibrium level. And here this graph basically shows what that exactly means, right? So you basically short it when it reached a level that's outside of the equilibrium, and then you'd end up closing the trade, okay? That's where the profits would come. So now we're going to be talking about financial machine learning, and this is a modern day idea, but we could see that Simmons basically was doing this like many years ago, even decades ago. So this is a paper, Financial Machine Learning. It was written by a couple of guys, Brian Kelly and Daicheng Zhu, the Yale School of Management, AQR, and NBR, and the Chicago Booth of Business. So the price of any given asset tends to vary over time in potentially interesting ways. This corresponds to the time series dimension of the panel. Meanwhile, at a given point in time, prices differ across assets in interesting ways. The cross-section dimension of the panel. So this kind of paper is going into like some of the uses of machine learning, and then also the different types of data that people are working with, right? So in the case of financial prediction, time series prediction, basically you're working with cross-section, multiple variables, and then you're also dealing with the dimension of time. And this basically gives a summary of what I'm saying. The profession has accumulated a staggering list of predictors that various researchers have argued possess forecasting power for returns. The number of stock-level predictive characteristics reported in the literature numbers in the hundreds, and macroeconomic predictors of the aggregate market number in the dozens. So there's a lot of macroeconomic predictors, and then stock market level predictors. I mentioned some basics like price earnings, price book. There's a bunch of other accounting ratios that could be used. Macroeconomic predictors, obviously the obvious one is either the Fed funds rate or the treasury yield and whatnot. So this is a little bit going to this paper, but they in the financial machine learning, but they use something called ridge regression, which machine learning people should be familiar with. Basically, it doesn't, it shrinks the coefficients that are not optimizing the model into smaller coefficients, so it has less influence on the model, right? And this could be useful if there's like hundreds or 200, 1,000 features, right? And it's a functional form that's used, right? And it's, as I was mentioning earlier with Simmons, this is what he would do. He would pick out hundreds or thousands of variables and fit it. We don't know the model, but in this paper, I think it's kind of filling in the information that we didn't get from his book, right? So we could kind of make these educated guesses. It's not precise, but the language he uses, we could kind of translate it into some form of math or modeling. So foundational premise of machine learning is that flexible large P model specifications can be leveraged to improve prediction. Their estimates may be noisy, high variance, but prove a more accurate approximation, small bias. So the idea is basically the more variables you get, the more likelihood, and if those variables are actually causal, it'll be, you'll make better predictions in trades, okay? It's important to note, going back a little bit, like when I was talking about how, well, it was discussed by the CFA Institute that Simmons didn't care about economic variables or these fundamental variables. He used them, but he didn't really care about it. He cared what empirically worked. So there would be like statistical features he could build from like ACF, or he could use technical analysis and build like features from a moving average. And if that worked, it worked. He didn't care. He was pretty agnostic to the variables, and that's important to note his mindset, because it's actually very pragmatic. So the paper that I just presented, it goes on to talking about different functional forms and methods, random forests, neural networks, recurrent neural networks, textual analysis. It talks about LLMs, not in depth, but some. And these are all things Jim Simmons may have been experimenting with, right? So it's important to keep that in mind, right? So the two things that he did really well were collect vast amounts of data, didn't really care. I mean, anything, the more data, the better, that kind of mentality. And then he used probably different model types, right? We're not sure about the functional forms, but in that recent paper, financial, machine learning for finance, we could kind of make some educated guesses, okay? So finally, we're just going to compare the two philosophies and finish off here. So fundamental is based on business value. Quantitative is based on data patterns. The tools used are financial analysis for the fundamentals. I didn't mention the DCF analysis, but that's the cash flow analysis, explicitly in equation form, but that's what Buffett basically does. Quantitative, it's math, stats, code. Strategy for fundamentals is long term, and the strategy for quantitative is short to medium term. The strength of the fundamentals is depth and judgment, right? So you've got like somebody like Warren Buffett, the archetype of value investing, and he reads annual reports. He reads like 4 or 5 different newspapers, and he's been doing this for years and years and years, and he's developed the habit. Okay, and that's why he's able to see things probably other people won't. But that's expertise, right? That's years and years of practice, right? He reads. I think I read somewhere he read like 4 or 5 hours a day or something like of that nature. Quantitative at speed and scale. Now, quantitative now, I mean, we've got like LLMs, so we could parse out information and whatnot if it's built correctly. That would be the first thing. And we could probably do something like a Warren Buffett, like build a Warren Buffett with an LLM. But I mean, it also requires some kind of level of judgment, some level of understanding of finance and how these LLMs work as well. So I don't want to say we could replicate like a great human being, like great investor like Warren Buffett, but it's possible ideally. The risk is the analyst bias, right? And for quantitative, it's model error. Okay, and I would like to add another point is that it's also you also have to be kind of aware of your own personal preference, right? If you're able to sit on something for 10 years, then you should probably be fundamental. If you don't have the patience to read 3, 4, 5 hours a day and sit on an investment for a long period of time and to see your theory and your hypotheses realized, maybe, and you do have the skills, mathematics and stats and whatnot, maybe you should be quantitative. Okay, so these are the two philosophies, and I'm going to close there. Thank you very much, and I hope to see you soon.